Vaidyanathan, Executive Chairman at Capital First. Vaidyanathan, good morning. Before we discuss some news items, just wanted to ask you, how's loan growth shaped up over the last couple of quarters, especially in light of demonetization? And, has that made you change any targets, or do you think you are, at par with the kind of rates that you have seen?
No, in the beginning of the year, we had anticipated a growth of about 25%, which is what we had given as guidance to the market and even to your channel. And we are very much in line with growth of 25%.
Mr. Vaidyanathan, good morning. Thanks for joining in. Well, the rule that RBI put out yesterday that loans above 20,000 will have to be given in non-cash form. It's been interpreted that not just gold loans, but any loan above 20,000 ought not to be in cash. That's what some people are reading the rule as. Will that affect your life at all?
No, not at all, actually, because we finance small entrepreneurs and small consumers, as you know, but 100% of all our lending and disbursals are in the form of credit to the customer's bank accounts, so it doesn't affect our life. Okay. I think it's a very welcome development, actually.
Of course.
Mr. Vaidyanathan, good morning. Just coming back to that demonetization impact, a large part, a big chunk of your portfolio comes from the SME segment, and that was one of the hardest hit post demonetization. Has that segment bounced back well, and what are the trends that you've noticed there?
Actually, that segment has bounced back very well. Just to share some numbers with you, in the month of December, we saw that the disbursals that we were doing on a month-on-month basis was down 30% as compared to what it was in pre-demonetization, that is in October. But that has actually sharply bounced back. It's already come back to neutral territory, as in it's become equal to the October numbers already in the month of February. So we think that this is pretty much behind us. It was a bit of a passing shower, I'd say. Even anecdotally speaking, to many entrepreneurs, people are saying that business is almost back to normal.
Okay, it's a season of acquisitions, Mr. Vaidyanathan, at least that's what the market is abuzz with. Anything that you are looking at in terms of any inorganic opportunities?
No, we are not looking at any inorganic opportunities. The way we look at it is that in our space, let me say most private banks and let me say other NBFCs, the whole market, which is largely in the private space, is growing comfortably at about 20% year on year. For us, considering that we're coming off a small base, for us to grow at 25% and to reach a loan book of about 20,000 crores this year end should be quite comfortable. The other thing I think which we haven't talked about, probably is relevant for your investors to know, is that last week or maybe a couple of days ago, Capital First has got upgraded to AAA status, and all our existing borrowings, bonds issued by us, which were issued at AA+, have got upgraded to AAA. So I think that's good news for all our people.
Oh, congratulations! That's certainly a very big plus for your margins as well. So if you could dwell on that, how will margins therefore pan out in FY18 or at least in the current quarter itself? Will it be better than what it was for the rest of the year?
Yes, our margins are constantly improving more because of the cost of funds that is changing, actually. And you're right. We have seen that cost of funds have dropped by about 50 to 75 basis points over the last 6 months quite comfortably. It's also, of course, because the banks dropped the MCLR by about 90 basis points. But bond markets, incidentally, are running distinctly 90 basis points cheaper than bank rates. So incrementally, we have actually replaced all our bank borrowings with bond borrowings. And that has reduced the cost of funds. So margins, an increase of about 100 basis points over the last 6 months is something that we're already beginning to see.
Oh, that much. Okay, now to speak about, Anuj was speaking about promoters flexing their muscles these days. What about Warburg's stake in Capital First? Are they looking to increase or decrease it? We also heard that they could be wanting to offload perhaps at a time like this.
Well, from what we know and what we genuinely understand them, They really like the company and they believe in the long-term story of the company. I think the real story of Capital First is yet to play out over the next maybe 4 to 5 years, as we believe that our loan book could compound from the current rate by over 25%. Profits could compound at maybe a rate higher than that. I'm pretty certain that existing investors will want to see that phase out completely.
So are they increasing?
I think it's a way off.
So would they be looking to increase this?
No, neither. I don't think they're increasing either. The rate, their stakeholder. Okay. No, because only recently GIC has come in and they have quite a 5% stake from the in the form of a preferential allotment. So there is no plan to infuse fresh equity. There is no need for it either because of capital adequacy being quite good.
So is there a time frame for Warburg to offload their stake if they're looking to do that?
Like I said, as a fund, their fund has a lot more life left in them, maybe close to about 4 odd years. But that's really, in our markets, it's a very, very long time. And there will be enough opportunities to deal with that matter in the days to come. But really, by that time, the company would be even larger than today. The franchise would be very, very strong. Profitability will be looking much better than today. So all things will be good. And we'll always find as someone at that point of time to give let me say, a smooth landing. And, the life will, because I assume that whoever comes in at that stage will be an even larger player to take a stake of that scale. So these things actually don't worry us, nor do they worry WP as far as I know. So things will play out quite comfortably, in my opinion.
Okay. But one of the most interesting things you told us, Vaidyanathan, when we last spoke, was that you are doing an increasing amount of algo-based lending. How is that developing? I think you told me that you do about 10% of your lending on algo. Are you more happy with the data? Are you going to increase that?
Well, that is playing out extremely well. And frankly, when we started this in 2010, which is when we put the basis of this algorithmic-based lending for maybe 10-15% of the portfolio, it was very much nascent. But what has happened specifically over the last 6 months, is that the ecosystem for doing everything has gone electronic, because of the platform of Aadhaar that came. And further, the algorithm has gotten better. So our sense is that this sort of lending has helped us open up new segments of marketplace at a much lower cost, which could otherwise not just be opened in a consistent way. And that's one of the reasons for our growth, because we are able to find some newer markets based on those technologies. So that's a USP, and we want to keep it that way, actually.
Okay, so can you just give me some numbers on that? Will you increase it from the current 10% of your book? What can it do to your overall margins and loan growth if this now expands into, a larger segment, the algo-based lending, because it would be so cheap?
Well, I'm happy to tell you it's not 10% anymore. It's more like 25%. So clearly that space is a big growing space for us.
Okay, so
and we can't just call it algorithmic lending, because what we do is that along with that, we do a number of, let me say, a few physical checks on customers to just make sure diligence is good in terms of physical verification. But all the same, credit decisioning does move away to an alternative method. Now, the issue about algorithmic based is not only for lending. Actually, it shows up in the form of collections, it shows up in the form of monitoring, and therefore the company becomes lighter and lighter on assets and becomes more productive in the marketplace.
So if you have to give a 5-year time frame, because you will be able to do so much of analytics based, then what is your growth trajectory?
See, like I said, in India, the size of the market and the opportunity is, for all practical purposes, I'd say unlimited, particularly companies like us coming from a very small base. So I'd say, therefore, we could grow even upwards of 25%, but a safe sort of guidance which people should know and factor for, and particularly with the AAA rating, I think it puts much more responsibility for us to grow even more responsibly. So in that sense, I'd stick to saying that a 25% would be a safe zone. Okay. We could do better, but that will unfold as the time goes on.
Okay,
That's a
Vaidyanathan.
blooming HDFC Bank, isn't it? 25%, 30% for so many years. Vaidyanathan, pleasure speaking with you. Thank you very much for joining us. I think we should take on board that algorithmic based or whatever analytics